Hello and welcome to Jazz After Dark. Sorry, a little bumpy there. How you doing tonight? Good. Tonight we've got a special, it's the Breckenridge Bourbon, but specially blended just for the Flaviar members, which if you want to join, we have a discount code. I don't think we get anything for it, but you can get a discount code for the monthly membership there. And I chose the bottle this go around because I'm a sucker for Buffalo Trace and Breckenridge Bourbon. This one was made, I think it was made a little bit sweeter, to be honest. And it is phenomenal. So I hope you have something you're enjoying with us tonight, because I'm going to teach you something. And this actually goes back to, I had flashbacks of 2011. I used to teach my former life. My job was to teach foreign investors, mostly based in China, some in Portugal and some in Israel. My job was to teach them how the US markets worked, educate them on the entire nuts and bolts of every little single piece. That's why often when you see me talk about little historical facts about the QQQQ now becoming the QQQ, that transition, the telecom sector becoming communication services, all this stuff throughout time, it's because it was my job to know the nuts and bolts of how everything worked. And then from there, we would trade, and we would do live trading to show them how to press the buttons and everything. And you had to make money or they would get a little frustrated. So those were good times. And I was having flashbacks because the Nasdaq is about to do something that it's only done one other time. It was 2011. I remember it vividly. I know exactly where I was. It's just like the flash crash, right? I remember I missed the flash crash because I was taking my mother to the airport. So I don't know if that's a blessing or, maybe a missed opportunity, but just funny how market movements, I remember these things. Anyways, I want to go over it because there are a lot of questions that unfortunately I know retail investors, you guys, may have that would lead you into doing something that's going to cost you money. We see these very complex things that the Nasdaq is doing, or when the S&P rebalances, or more particularly the Dow, and we think that something's going to happen. I'm going to share the data with you to show you pretty much exactly what's going to happen and why you want to be careful. So if you don't know, the Nasdaq does regular rebalances. Now, this is different. The Nasdaq's rules, you can actually look this up. Their rules are still, and have almost always been this way, that they will rebalance quarterly so that no one position can have more than 24% of the index. And that's because, I don't know if it's an SEC rule, but that's because way back in the day, the regulators, I presume FINRA or the SEC, said, hey, if you want to be considered a diversified product and be considered to be used as an index, well, you can't have one position account for more than 25%. Just like mutual funds can't have a position that's more than 5%. It could be cash, I believe, but you can't have a very large position. You have to be diverse in order to fit into that crowd, the rules of the game, so to speak. And so you never hear about these rebalances. They're automatically done. We already know what they're going to be ahead of time because we can calculate it that position at one point, Apple had over 24%. They rebalanced, they solved that problem, no big deal. So that's a normal rebalance. The historic thing that's happening now, which only happened in 2011 and is going to happen next week, is what's called a special rebalance. I'm going to show you, getting a little in the woods here, but they have a just like paragraph, whatever, subchapter A.1/B, like some weird place in the rules. It says, any stock that has over 4.5%, we will put them in a separate bucket, just in the back of our minds. And we will always watch the stocks that collectively have 4.5%, 4.5%, 4.5%. Whoever's in that category, you could probably guess a few names right now. As a group, we will never allow them to have more than 48% of the Nasdaq. They can never, as a group, no matter if there's 10 of them, 50 of them, whatever, it can't be 50, but no matter what there are, they cannot account for more than 48%. If that happens, we will do a special rebalance to solve that problem. Honestly, I don't know why they chose 48%, but that's their rule. So here's what's happened. If we look at the Nasdaq, what we have is their target, 48%. Any stock that has over 4.5%, it was in NVIDIA, Amazon, Alphabet, Apple, and Microsoft. Tesla hit 4.5%. Well, as a group, when all of these were added up, they said, whoa, wait a minute, because of the big spike in NVIDIA, we hit 51%. That's since pulled back, but nonetheless, that triggers a special rebalance. And so then they tell us, they say, okay, well, how are we going to do this? And so they break down the percentages. Don't worry so much about those right now. We'll get to those in just a second. So those are the rules of the game. You know how this will go in the future and for every quarter that they do a rebalance. Let's talk about what it means for you. So if you take the top 5 stocks, which in this case is dark blue, and the top 10 stocks is light blue, look at their weighting since 2000. You can see that occasionally we get close. One time we got close there. And we've been working on getting to this point. Now, this is only the top 5, so there could be more than 5. It's just an example. But to show you the change in weighting, it is a constant issue that they have to deal with. The top 10 stocks, when NVIDIA popped, they were 61% of the Nasdaq, which means 61% of the returns in the Nasdaq were only attributable to those 10 stocks, or more interestingly, only 10% of the entire index was driving more than half of the returns. You could see how that gets to be dangerous at some point. So let's dig into this a little bit further. Here's how this is going to go. I shared this on the closing beat. I'm going to go in more detail with some more data here in just a second. But what we have is the top 25 names so that you can see, we got their name in here. We have their returns year to date. Anytime I share with you data on a table, I always include year to date, whatever's most recent for them. Oftentimes it's 1 month. I'm doing 1 week in this case. And then their market cap, just because of the way our scanner does it, I just leave those as a default. But side topic. I'm just trying to point out what the data means. In the S&P, you can see each one of these stocks' current weighting. Now, there's no problem over there. That's, not in my opinion, but there's no problem for the moment as far as the S&P. The Russell 1000 Growth Index, currently no problem. It's getting a little heavy weighted, but they have a whole separate set of rules. We go over to the Nasdaq. Here's what we have. We have Apple. This is a day behind, right? So this is getting posted 1 day later, so it could change today. We're at 12.1%. It's going to go to 11.5%, okay? And so you can see the change in percentage. Now, before I get to this side, let's just look at a couple here. 12.8 to 9.8. It's a big reduction to Microsoft. Alphabet, a reduction. Amazon, where's NVIDIA? 7.3 to 4.3. It will no longer be such a driver of the Nasdaq. So it's getting a little bit rebalanced there. Now, what you're saying, guaranteed what you're saying is, oh, wait a minute, Dustin, I saw this right here. You mean that $1.4 billion would need to be removed from Apple, from all the different players out there? I'm sorry, I'm just going to talk about the Nasdaq for a second. We need to remove $1.4 billion in order to get to 11.5%. That's 13% of its average daily trading volume over the last 3 months. So this happens Monday, the 24th. So an additional 13%, if this all happened in 1 day, an additional 13% or $1.4 billion would need to readjust. Why would it need to readjust? The Nasdaq is just an index. It doesn't hold the stock, right? Well, there's index funds. There are mutual funds that track the index or at least use it as a benchmark. And so they have their positions. ETFs, various positions that do this. There are index ETFs. There are aggressive growth or large cap growth ETFs that use the Nasdaq as their benchmark. Well, they have to readjust. This will happen algorithmically. The algorithms will take care. There's no human making this decision. But so this will take place. If I had a Nasdaq fund, index fund, I would need to adjust. Otherwise, what's going to happen? I'm out of balance from my target. Right? That's my benchmark. So I've got to adjust. If I had $10 billion in this fund, I need to move positions, right? Where are they going to move to? They're going to move down here. So these guys are losing their part of their share because they've done a lot of heavy lifting and they're worth more now. It's a modified weighted average. And so down here, these guys are going to be the beneficiaries. These are all the names and exactly how they're going to go about doing it, all the way down to Starbucks. Okay? So now you know that. And like I was saying a second ago, I guarantee you're saying, is there an advantage here? Wait a minute. Should I short these stocks if there's going to be all this volume coming out? I own Apple, Nvidia, Amazon. Should I sell it and then come back after it pulls back? Don't lie. Tell me. Put it in the comment section. This isn't live or anything, but tell me, right? You thought about that. A good investor would. Everybody, we all think about that. The house down the street's looking a little ratty. The weeds are growing up. All of a sudden, they stamp a for sale sign. You're like, damn, I can't afford that, but that's a deal, right? You do it. Don't lie. So good. So, is there an advantage? Well, no, I'm sorry, there's not. This will not all happen in one day. In fact, it's already started. You can track the volume and see that they're already starting to adjust because this was announced beforehand. All right, let's take a look at one of the reasons why this won't happen. We can look at the weighting of mutual funds and ETFs to the benchmark without going crazy here, unless you want me to. The ticker symbol Apple in any index, our system calls it core, this just means index. So any index fund that uses the S&P as a benchmark currently is not up to the index standards with Apple. So how you would explain that is you'd say Apple in the S&P is 7.5% currently. Again, a day or so behind now. They are not 7.5%, they're 3.6% less. So they're underweight. They're behind already. Okay, not such a big deal, unless you care. Growth funds, and in particular, I'm using, if you want to search yourself, any growth fund that uses a Russell 1000 as the benchmark, because that will include all these symbols. That's why we chose it. Growth funds. Well, wait a minute. Did I put it on the other one? Russell 1000 growth funds. Apple, 12.9%. That's the benchmark of the index. They're highly underweight. Value funds, a little overweight. So as a whole, they're underweight. Microsoft, you're seeing similar scenarios. Basically, they're underweight. Underweight, 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 underweight. You get the idea, right? So what does that mean? The majority, or I should say the average, because that was based on an average. So the average mutual fund that's based on or uses the benchmark as their goal already doesn't have these positions. They've already taken it upon themselves to sell while you're tripping over yourselves to buy NVIDIA. So therefore, when we go back and we say, oh my God, $1.4 billion, oh, you can't see it, $1.4 billion has to come out, or 13% of the average trading volume there. Well, that's if they were equal weight. They're already underweight. So this adjustment from 12.5 to 11.5 is actually helping them, right? They're still underweight, but, sorry, I should be here. It's still helping them. So is there going to be a lot of selling pressure? No, they've already done it, right? So just don't think that there's like an opportunity in that case. Now, the last thing I'll share with you, I know we're getting into way more geeky things here than we normally do, but this is exciting, right? Dustin, this happened in 2011. Could we see some data? How did things go around there? Maybe you're just feeling a little bit passionate about this and you're wrong. Maybe. Let's take a look. So this is 2011. I did this in 3 different ways for you just because some of you really, really like the equal balance that we do sometimes. I see the comments. Okay, so last time they announced it, April 5th, 2011. The light blue line is Microsoft, the dark blue line is Apple, and the green line is if you only owned the Nasdaq without weighting. Like you didn't care what the weights were, you just owned the entire Nasdaq. We do this sometimes with the S&P. Okay, so if you look at the Microsoft and Apple, ahead of the announcement, they were already trending lower. When the announcement took place right here, from there to the actual event, I don't know, like not much, right? Maybe slightly up and then Microsoft slightly down. Nothing to write home about, right? And then after the event, they did sell off a little bit. We're talking, Microsoft was already on the way down. So a total of 7% from here to here, but kind of started recovering. And then from there, went all the way back to highs, right? So a little bit of pressure there, but not really much. So from here, that's like 3%. Over the course of months, by the way, you all know that we don't see 3% in a month like we used to. We see that sucker in a day. So 3% in that time period, not really enough. Like that'd be a blip on the screen here today if you account for 2023's type volatility. So keep in mind that that was from April 30th to the end of May. You know what I mean? That was a whole month and a day, right? Technically. So bottom line, is there an advantage here? Not because of the rebalance. You could certainly argue there's an advantage to not buying NVIDIA and waiting just because it's overbought. Certainly. Apple, you could make the argument, okay, the rebalance is what it is. Funds don't really have to rebalance because they're already underweight anyways. Now you know, sound cool and smart in front of your friends. But you could argue, yeah, I'm just not going to buy it. I'm going to wait just because I think it should pull back, or it's overbought and I'm not interested. So you might use that as your example. And you might be one of those that says, now you got earnings coming up and I don't mess with those earnings. So I could understand that as well. All right, for those of you that had no idea what I was talking about, hopefully you now know, like, hey, okay, don't do something there because you think you know what's going to happen and they're making a big deal of it on TV or whatever. Now you know the details and you have to watch it a couple times. I appreciate the views. This is the kind of thing that I enjoy teaching so much because no opinion. Did I give my opinion anywhere? I suggested what could be an opinion, but it's just the data. That's a lesson that you'll never forget, right? Especially those of you that are into that. That's the kind of thing I love teaching clients. I love teaching you guys, and I appreciate you guys watching. It is horridly late here. Tonight was softball night. I play on a softball team. I was pitching, right? I was pitching. Only had one forced run there off of having 3 bases. I walked a guy there, but otherwise, just your man out there throwing a softball. There's a net, so nobody can hit me in the head. We lost the game, but you're not paying attention anymore, so it doesn't matter. We're still heroes, right? Yeah. All right. I will see you guys tomorrow on the closing beat. Adios.